Good afternoon, ma'am.
Yesterday, we have started with this topic, financial context of business, part 3, under the discounting and investment appraisal. So, as part of that, we've just understood about what's the time value, what's the concept of time value of money, what is time value of money. As the passing of the time, we see that the value of money keeps decreasing. So, what were the reasons why the money has a reduced time value on account of the time? So, because of cost of finance, because of investment opportunities, inflation and risk. The what could if the cash flows are discounted, at what is the rate at which these cash flows are discounted is the concept what we have to look into. So now the discount rate, usually if no other information is provided, would be the interest rate, the rate of interest which is taken up, which is prevailing in the economy, that will be taken up to discount the cash flows. In situations where such information is not available, we also take the weighted average cost of capital to be as the discounting rate or the minimum required rate of return. To proceed further, let's see the concept of what is the compound interest, the simple interest and the compound interest. To begin with, if we we have to denote certain variables. These are all mathematical expressions which you have already learned in your school days. After that, at your graduation level, you've also learned that. Once again, let's just quickly run through this content and proceed further. So there are certain variables which are used. The initial investment amount is denoted as P, principal amount. Then R is the rate of interest which is paid on the investment amount R. Then N represents the number of periods, number of time periods. Okay. Finally, when we calculate what is the final value, B is the final value. If at all, if there is a principal amount which is invested as on today, this investment will attract interest at the rate of R. R is the rate of interest. At the rate of R%, interest will be calculated for as long as the time period, for n number of years or n number of time periods. So taking the time period as n, calculate what is the value of B. Okay. There's a simple example given to find, say, 7%. 7% can also be written as 0.07 basic. In general, R and P gives us R percentage of P. So, we know that. See, when investment is made, let's say if 100 rupees is invested, see, when interest is earned, take any percentage, if we take to be as 5%, it would be 100 into 5, 100 into 5%. So, R into P, as simple as that. That is basic, that is logical. So, this part of it gives us what is the rate of interest applied on the principal amount. So, when that is added, we see the final value stands at 105. So, simple interest follows this B is equal to P plus R into P. But what if it is compound interest? What's the concept of compound interest in the first place? See, let's say if 100 is invested, in this example, by the end of first year, it would be 105. Okay. Simple interest says that every year calculate interest on the face value. On 105, interest would be calculated. So as many number of, if interest amount is 5, see this part of it, if it is 5, so as long as the investment is invested or the amount is invested into, so for that long period per annum at the rate of 5%, the same amount will be paid. That is simple interest. But in case of compound interest, we know that by the end of first year, if it becomes 105 in this example, now principal amount will become 105. On that, then again, interest will be calculated. See here, the logic is 1 into 1 plus r. 1 into 1 plus r is, see here, if we talk about this equation, this is principal amount in bracket. If we take it, the common factor is 1 here, and here it is r percentage. 5 by 100 is r percentage. So that's the equation. So 100 into 1 plus r gives us 105. Now, next time when interest is calculated, interest would be calculated on 105. So the interest rate will be accumulated period after period. So the simple interest equation is P into 1 plus R, or P plus R into Pn, the number of time periods. But here it would be 1 plus R whole to the power of n. So that many number of times. See, the logic here is, let me put it see, when interest is calculated, principal into 1 plus r. So principal is, for example, if it is 100, see, on this interest will be calculated as 1 plus r. One more year, if it is interest is calculated, again that for that year, again into 1 plus r will be calculated. For the first year, then for the second year, then for the third year, it goes on and on until it reaches the nth period. So it goes on like this. So in that case, we will have it as 1 plus r in the nth year. So this is to the power of 1. A into a is a square, a into a into a is a cube, a into a into a, so on. It will become a to the power of n. So we have the equation principal amount into 1 plus r whole to the power of n. Okay. So there is a simple example given here. If 200 is invested at 6.5% per year for 8 years, the final value is calculated as 200 into 1 plus r is 6.5 by 100 whole to the power of 8 long years, so to the power of 8. So mathematically we can solve it that way. The mathematical calculation goes on like this, but we also use it, the financial tables, and then solve it. Okay, just 1 second. The next concept is what is equivalent rates of interest. The previous example, what we have seen, the interest rate was calculated at the rate of 6.5% per year, and if and the amount was invested for 8 years. So at the end of 8 years, what's the value? We apply 6.5% for one year into 8 long years. But not necessary that interest is always paid per annum. Interest could be paid in for any time period. It could be semi-annually. Every 6 months interest could be paid. Every quarter interest could be paid. Every month interest could be paid. So if that is the situation, then how do we calculate? So the equation says that the equation is P into 1 plus R whole to the power of n. But let's say if instead of paying for 8 years, every year instead of paying that, they are paying every 6 months. If that is the case, how many times in a year, in a period of 8 years, the interest will be calculated? The 8 years, If it is annually, 8 times will be paid. If they are paying for every 6 months, that is 2 times in a year. Altogether, during that 8 years time period, it will be calculated at the rate of for the amount of 16 number of times the interest will be calculated. So what happens to the equation? We have the value equation is equal to P into 1 plus R whole to the power of N. But if we see that interest, if it is not paid per annum, but if it is paid for every 6 months, so in a year they would be paying 2 times. So in 8 years, how many times will they pay? They will pay n into m number of times. M is the number of times the interest is calculated. Okay, the exponential will become n into m. Then the R is a percentage for 1 full year. If R is calculated as per annum, but they are not waiting for 1 full year to calculate the amount of interest. So they are calculating it for 6 months only. Rate is 8% or R% for 1 full year. But if it is for 6 months, it should become R divided by M number of times. How many number of times they are paying? That many number of times R will be divided by M. So the equation will be P into 1 plus R by M whole to the power of N into M. So that is how the interest calculation will take place. Examples given, she raised the monthly ratio to the power 12 to give the annual ratio to take the 12th root to go from annual to monthly. Examples are if 2% per month. So if it is 2% per month in a year, how many times will they pay? They will pay 12 times every month. If interest is calculated in a year, the interest will be calculated for 12 months. So in this example, if we would have it as P into 1 plus, if it is only for 1 year, let's say that the percentage interest is 2% per month. So 2% per month, since it is already given per month, but the exponential would be in a year, they will have it calculated as 12 times per monthly, no, 12 times. So it will go like this. So annual equivalent rate, see, annual ratio is 1.268. Annual equivalent rate, we just multiply it into 12 times. Okay, so that comes up to EAR, annual interest rate, is equal to the EAR, we got it as the power is raised to 12%, 1 plus 2% whole to the power of 12, power is raised to 12 times, and we got it this. EAR would be from this 1.268, 1 is deducted, annual ratio minus 1. So here it will be, if this minus 1 is deducted, it will be 0.268 or 26.8%. 0.268 or 26.8%. Okay, that's how annual annual equivalent we call it as equivalent annual rate or annual equivalent rate is the annual ratio what we've calculated minus the minus 1. Just remember that part of it. There's another example. If it is 24% per annum, how do we calculate? So it's calculated and it's given to us. We can proceed further with solving simple questions from the examination kit. Now, if in case the value has to be calculated, the terminal value is the value of money at the end of the investment. At the end of the time period, what is the value? That is the terminal value. Last, final value is called as the terminal value. There's another concept of sinking fund. So sinking fund is a series of equal annual investment which are invested on that periodically the interest is calculated. A sinking fund is a series of equal annual investments intended to provide a known sum at a given period of time. So to to receive X amount of investment at the end of the period, what are the equal annual monthly installments or periodic installments? So now to have this figure at the end of a time period, how much should be invested into the account per month or per period, so that these investments accumulate the interest calculation and sum total of it equals to X amount of period. So that would be sinking fund. So what would be the equal annual installments which would be paid into the account so that these installment amounts also earn interest and the sum total of all the cash flows equal to the final terminal value or the final investment amount which they are expecting to receive. Example given are, you want to set up a sinking fund to replace an asset worth $10,000 in 5 years time by investing P at the end of each year for 5 years. If the rate of interest is 4%, find P. So if what is that amount of P? P is the principal amount, okay? To have 10,000 in the account at the end of the period, what amount should be invested into these are equal annual installments. So what amount should be invested? We see that P is equal to the total investment divided by 1 plus R divided by 1 plus R whole to the power of see, to have a investment worth 10,000 in 5 years by investing at the end of each period. So by the end of first period, end of first period, one, two, three, four, five. So we have 3, 4, and finally it is 5. So when investment is made at the end, so the amount which is invested here, the investment amount will be earning interest for 1 time, 2 times, if it is 3, it is 4. So altogether it will be earning interest for 1 time, 2 times, 3 times, 4 times. Okay. The second the amount which is invested at the end of second year, it will earn interest for 3 times, third year, fourth year, fifth year. The investment which is made at the end of third year will earn interest for 2 times. Fourth year will earn interest only for 1 time. Fifth year, because it's at the end of fifth year. Okay. So we have the interest calculated as P into 1 plus R whole to the power of 4 times, 3 times, 2 times, 1 time plus is equal to the amount which is deposited into the the amount which is expected to be received at the end of the period, which would be 10,000. So what are those P amounts which would be invested into the account? So simplify that and then find out. Okay, then mathematically we are doing that, but actually technically speaking, for us we don't have to learn so much of mathematical aspect. We just can straight away go up to looking into the table values and then find out So we have certain techniques in capital budgeting called as there are altogether 5 techniques. We see that one is payback period, one is accounting rate of return, the other one is net present value, then internal rate of return, and then profitability index. So these are the techniques which are used to find out what is the present value of the cash flows and whether the investment is worth investing or not. So basically, we have learned it by way of looking at the financial tables, the present value table, the future value tables, etc. Now, when we look into the examination kit questions, um, the examination kit questions have these things. So we just, as far as possible, if we can write it here, we will write it here. But otherwise, if the calculation is little lengthy, let's take these questions to an Excel file, try to answer them there. Okay, as many as we can solve, we will finish it off in today's class. The concept is simple, nothing new that you are learning it for the first time now. We see 136 a credit card companies charging an annual percentage of 25.3%. This is equivalent to a monthly rate of what? So we are asked to calculate the monthly rate. It's a simple concept. How do we calculate monthly rate?
That was one monthly rate, 1 plus annual rate, the power of n and n.
The annual percentage rate is 25.3. We want the monthly rate. As simple as that.
Yeah.
So how do we work it out?
Actually, 1 plus annual rate to the power of 1 by 12. That is the monthly. So,
So first find out what is the annual ratio. Annual ratio is equal to 1 plus whatever is the rate to the power of tell me 1 plus the rate is
it is 1 point,
25.3%,
yeah, 25.
0.253. Now this is calculated it for 12 times in a month. So 0.253 whole to the power of, because it's only for 1 year, 0.253 whole to the power of 12. After we calculate that, this is the annual ratio. Do the calculation. This is 1.253 whole to the power of 12.
I'm getting 11.9. That is 1.1.
Your calculator, you have that feature.
I just did into equals. That is 1.253
This is annual percentage.
into,
So this will become by 12. Sorry. This will become by 12 and that will become the example which we have seen in the PPT. They say that the percentage is per month, but here in this question we have it as per annum. So we have to be very careful about that. It is per annum, so 25.3% divided by 12 into whole to the power of 12. So this will be, how much is this? The calculation is coming as 28.45. 28.5. In that way. What's your calculation?
Ma'am, I'm trying, but I didn't get the amount you said.
It's 1 plus 25.3% divided by 12. So 0.253 divided by 12 whole to the power of 12. That's the logic when we see what is the annual interest rate.
So
So
for the bracket, we'll be getting 1.021, something
whole to
like
the
that.
power of 12. So is equal to minus is deducted. I am getting it as I also have tried it in Excel sheet. I just opened an Excel sheet and the calculation is 1 plus the interest rate divided by 12 to make it as monthly rate whole to the power of 12. And sometimes we don't get the logic clearly. A credit card
Yeah,
company
yeah.
is charging an annual percentage rate of 25.3. So it is 0.253. If it is annual rate, we should make it as monthly rate. So we made it as monthly rate. 1 plus monthly rate whole to the power of 12.
Okay,
After
okay, ma'am.
that will be annual ratio. From annual ratio, we have just have to deduct 1. We can see that little later. We'll go, time getting wasted. We'll go with the other question. Question number 137, a bank offers different bank accounts with different interest rates. So bank account 1 has 10% flat interest rate per year, interest calculated quarterly. Bank account 2, 12% flat interest rate per year, interest calculated monthly. 3 is 1.2% interest per month. 4 is 3% interest per quarter. Which account gives the highest annual effective interest rate? Annual effective interest rate. Interest is calculated quarterly, monthly, per month, per quarter. Let's take it out for the same logic here. One plus this is 10%, 0.1. Interest is calculated quarterly, 0.1 divided by 4, 4 number of times, whole to the power of 4. After that, we have to deduct minus 1 to get the rate. Point 0.025, 1.025 whole to the power of 4. We'll do one thing, we'll take this into Excel. So Excel calculations are also very easy. I'll put
Yes,
this one
yes.
in Excel sheet. Um,
First, I've given 10.38 for the quarter part.
okay. I brought the questions to the Excel sheet. We'll try it out here. 137, question number 137. Bank account 1. The calculation would go like this. We will have it as 1 plus percentage of interest is 10% divided by 4. Interest is calculated quarterly. In a year, there are 4 quarters. So 10% divided by 4. The entire thing exponential to the power of 4. This 4 times interest is calculated. This is the equation. So if we are to find out the value, and from this one, we also have to deduct -1. -1. So this is 10.38.
Yeah.
Similarly for bank account 2. Bank account 2 is paying interest. 12% flat interest rate per year. Interest is calculated monthly. So 1 plus 12% divided by 12 times, because monthly, exponential to the power of 12. So this is the equation what we have to calculate. Let's just copy this one. We got it as 12.683. Then we have bank account 3. Bank account 3, we have it as 1.2% interest per month. So directly we can write it here as 1.2% interest per month. And this is 1 plus per month interest is already given 1.2% whole to the power of 12 times. One plus, it's already 3% quarterly. There are 4 quarters here. Now, if we multiply into 100, it becomes 10.38%, 12.68%, 15.39%, and 12.55%. We tried to do it here also, but I don't know, somehow it's not working out. They are charging an annual percentage of 25.3%. So 25.3 divided by, we are making it to monthly, divided by 12. And the power raises to 12 times. After we do that calculation, we have just to have to deduct -1. I don't know why is it not good. Equivalent. Now give me the answer. Which one would be the right answer?
So it will be
Which bank?
the highest annual. Third one month, 15.39. So bank account.
Bank 3, because Bank 3 has a rate, highest rate 15.39%. So Bank 3 is C. We'll work it from the Excel sheet. After this calculation, we have question number 138. A company is expecting an income stream of 10,000 over the next 4 years. If a discount rate of 10% is to be applied, the level of income in year 4 would be worth. Level of income in year 4. So it is a company is expecting an income stream of 10,000 over the next 4 years. If a discount rate is to be applied, the level of income in year 4 should be worth in today's term. So basically, we just have to find out what is the discounted value. So 138, question number 138. The details given to us are R is equal to, or the discount rate R is equal to 10%. See, the cash flow is given to us at the is equal to 10,000. So what is present value? So present value of cash. Present value is equal to what? That is what we have to find out. So value as on today is equal to whatever is the cash flow. See, if the interest is accumulated, we will have it as into 1 plus r whole to the power of n. But when we find out the discounted value, it will become 1 by 1 plus k or r. I'll explain to you the logic. 1 plus r whole to the power of, here it is n. See, when we are trying to find out the value at the end of the period, value at the end is equal to, we have the principal amount P multiplied into 1 plus r whole to the power of whatever is the exponential value n. Okay, so we know what is the value at the end of the period. Value at the end of the period is 10,000 here. We do not know what is the principal value or the present value as of today. So P is what we are trying to find out. P into 1 plus r whole to the power of n. So when we are trying to find out what is the value of P as on today's value, is equal to, it will go as 10,000 divided by 1 plus R, the whole thing to the power of n. So whenever we discount it, the discounted part goes into the denominator. When we are compounding it, it goes to as a multiplication. So p into 1 plus R whole to the power of n. But the same case, if we are trying to find out what is p, so p will be 10,000 divided by 1 plus R whole to the power of n. So value is equal to, I'm writing it here, the calculation. You can see it in the formula bar. 10,000 divided by, we have it as 1 plus R percentage is 10%, the whole thing to the power of n is 4 years. Okay, this is 6,830, option D. 6,830. I hope I made it clear. Did you get the point?
Yes, ma'am.
Question number 139. 139 says that HJF company is considering a project which has the following cash flows. We have 0, 1, 2, 3, 4. Calculate the net present value, and the discount rate is 10%. So I'm just doing it here. Question number 139. See, we have the time periods given. Year is given. Year starts from 0, 0, 1, 2, 3. Then we have the cash flows. In 0 year, it is a negative thing, minus 200. Otherwise, it is 750 positive. Then we have das 500 positive. The last year, it is again negative 300. Okay. We need to find out what's the present value. What is the formula for NPV, net present value? Net present value. So the net present value will be present value of cash inflows minus present value of cash outflows. The intention is to ensure that the cash inflows exceed the cash out. It should exceed the cash outflows. Now, if in case the present value of cash inflows are greater than cash outflows, obviously it would be a positive figure. So, if the NPV value is a positive figure, then we end up selecting the project. Otherwise, we reject that. So, that's the criteria here. Now we see that there are two different in 2 periods, there are 2 different cash outflows. Okay, but we also have the in 2 years we also have the cash inflows. But whatever it is, we have the rate of discount as 10%. So what we'll do is, first we'll find out what is the present value cash flows at 10%. So let me just write a PV factor. PV factor at 10%. Factor. Okay. So we have PV factor at 10%. After that, what does it mean by PV factor? the mathematical calculation, whatever we have done by 1 plus r to the power of n, etc., that can be calculated beforehand and just simply multiply into that. Here, whatever is 1 by 1 plus r whole to the power of n, the 10,000 into 1 by 1 plus r whole to the power of n, that part of it can be pre-calculated, and that pre-calculated value can be written here because it is Excel. We should be doing it very easily. The 1 plus whatever is the power, value whole to the power of 1. So here whole to the power of 0. Anything to the power of 0 is always equal to 1. So for 0 here, the present value factor, whatever is the rate, doesn't matter. It still will be 1. Anything to the power of 0 to the power n is 0. Anything to the power of 0 is always equal to 1. So irrespective of the percentage, anything given, the present value in the 0th year is always equal to 1. Now comes the next year. So is equal to 1 divided by 1 plus, what's the rate? 10%. Now whole to the power of the time period, you write it here. Time period is given in this particular cell. Just drag it and then you will get what is the present value factor. Easy, one step, it will be done. Now each period's present value, if we find out, present value of cash flows, if we are to find out, we just multiply these two columns. When you add it up, all of them, because the positive cash inflows minus the cash outflows. So already cash outflows has a negative sign. So if we simply add it up, we end up getting the there is an auto sum. If we do that, we would get the NPV value, which is 669.6469. Is that clear? See, the examination, if you are allowed to use an Excel, that's the advantage. Things can be done very easily, very simply. We can do the calculations. Are you with me?
Yes, ma'am.
So, shall we go to the next one?
Yeah, ma'am.
Question number 140. 140 says an annual rent of 2,000 is to be received for 10 successive years with the first payment due tomorrow. The relevant rate of interest is 8%. Calculate the present value of this stream of cash flows. So tomorrow is as equal to as today. So it is 0 year. Let's write what is the present value of all the cash flows of stream of cash flows. We have it as question number 140. The cash flows are for 10 long years starting from today or rather tomorrow. So it is for 10 long years. Then in that case, we have to find out what is here is from 0 to the rate of interest R is equal to R is given as 8%. Here is, see, the first rent will be paid tomorrow. It's due tomorrow. It would be received for 10 successive years. So starting from 1, 2, 3, 4, so on for 10 successive years. See, the point here is the way we've done in the previous situations 1, 2, 3, 4. Like that, we can also do it for altogether 10 payments till the 9th year. So because it's Excel, I will take you through that. 0, 1, 2, 3, 4, 5, 6, 7, 8, 9. So altogether 10 payments. These are altogether 10 payments. The cash flows are same, which is 2,000. 2,000 is the cash flow. I'll just show you this one and then I'll also show you the alternative method. Now the same way we have to find out PV factor. At 8%. So here it would be 0 here is always equal to 1. Then we have the next one is equal to 1 divided by 1 plus the rate of interest is 8% whole to the power of 1. Just drag it down till here. Okay. What can we do? We need to find out what is the present value of cash flows. Present value cash flows. Multiply them 2,000 into this. Add it up and we would get it as 14,494. So this is present value cash flows. Present value of cash flows. Since it is Excel, dragging it becomes easy. But if we are to do it manually, see, when you do it in the examination, you will be provided these table values. So then also it is no issue. See, because all of them, for all the periods, it is the same. What can we do? We can also do it, calculate the present value factor. There is an alternative method wherein we can take it as present value of cash flows is equal to take 2000 into the sum total of all these things. See, the sum total of when we add all of them, we have the 7.24688. Seven point 24688 is equal to 2000 into. So in one single step, this can be done if we know these values. So in the examination, if you are to do manually, these table values will be provided. So what you can do is the zero here, always the factor is 1. At any percentage, it is always 1. Take 1 plus the rest of the nine periods factors, add them up, or the added values would be there available in annuity table. There are 4 different types of table values given. One is present value factor, second one is present value annuity factor, then we have future value factors, then we have future value annuity factors. So annually, if it is the same thing, that is how we can do. We can take nine periods annuity value, take that plus 1, the entire thing, multiply it into 2. If you are to do with the Excel, this is the way we can do, because just do calculations for one particular set, and then we just drag it and then find out the difference. So the answer here is D, 14,494. Then we will see the next set of questions, 141 onwards. See, a building society adds interest monthly to investors' accounts, even though interest rates are expressed in annual terms. The current quoted rate of interest is 6% per annum, and investor deposits 1,000 on 1st January. How much interest will have been earned by 30 June? So there are 4 options given. Find out that. So I'll take all these questions to the Excel file. Building society adds interest monthly to investors even account, even though interest rates are expressed in annual terms. The current quoted rate of interest is 6% per annum. The investor deposits 1,000. How much interest will have been earned by 30th? So on 1,000 interest will be calculated. So how much interest is calculated? That's the question. So interest will be the present interest rate given is 6% per annum. But if they are calculating it as 12 times, because monthly, so we have to divide 6% divided by 12. Then to the exponential power, we will have to increase it to 1,000 into BC1 plus R is 6%. This has to be divided by 12. It is divided by 12, but the interest is now calculated only for 6 months. How much interest will have been earned by 30 June? So from 1st January, it is only 30 June. So exponential will be for 6 months. So the total amount is 1,000. Um, the interest would be on 1,000. This is calculated. Value is 30.378. 30.38. B is the option. If L&D's new investment project generates NPV of 928 when the discount rate is 10% and minus 628 when the discount rate is 20%, what is the internal rate of return to two decimal places? First, let's understand what is IRR. Let's understand the concept of IRR. Then we can do the interpolation. So We'll go back to the PPT. After NPV, we have the concept of internal rate of return. See, when there is an investment made, the decision will be to ensure that the investment, when it is discounted at the discount rate, all the cash inflows that flow into the business should exceed. Cash inflows indicate the benefits. The benefits should exceed the outflows or the investment amount. In that case, the project would be accepted. Now that's the concept of NP. Internal rate says that, see, when there is a cash outflow, as against which there are cash inflows, these cash inflows, when they are discounted at some R percentage, some discount rate, the sum total of all the cash inflows discounted, when we discount it, we call it as 1 plus K or R, whole to the power of N. The cash flows, whatever are the cash flows, when each of these cash flows, when they are discounted at a discount rate to the power of N number of times, the sum total of all the cash in discounted cash inflows, at what rate when they are discounted, they become equal to the cash outflow. They become equal to the investment amount. That is what we are trying to find out. Are at some rate, let's say that if there is an investment made worth 10,000 today, so as against 10,000, there would be certain amount of cash flows expected from year 1 till year end. So these cash flows also have to be discounted to find out what's the present value. So at some rate when they are discounted, so now we do not know what is the rate at which when they are discounted. When they are discounted, all these cash inflows, when discounted at some R percentage for N number of years, the sum total value should be exactly equal to the cash outflow. Okay. So now the equation seems a bit complicated that we cannot pick out R separately out of that. It is summation of cash inflows divided by that is there in the denominator, and moreover we also have an exponential. To simplify that, it is not a simple task. So generally IRR is calculated. So IRR, when both of them are equal, the discounted cash inflows and the cash outflows, when they are equal, cash inflows minus cash outflow, NPV will be 0. That's the point. At IRR, NPV is equal to 0. See, when the cash flows, now since R cannot be very easily in simple steps calculated, what is done is there is a trial and error method which is adopted. So some rate which is adopted, and then let's say it is R1. So R1, when the cash flows are discounted at R1, if the NPV is positive, we plot it here. This is positive value. Since it is not working out, we increase the rate of return and take the R value at a higher value, discount it, and find out. So cash inflows are discounted at a higher value, and when we find out the present value, the NPV, the net present value, if it becomes negative, it is plotted here. What is IRR? We don't want it as a positive figure, we don't want it as a negative figure, but rather we want the NPV to be 0, which means that exactly the present value of the cash inflow should be equal to the cash outflow. So NPV should be perfectly be 0. But since we are trying out a trial and error method, very precisely estimating, assuming a rate and working it out to be as NPV as 0 is not a possibility. So in that case, there is an interpolation which is done. Interpolation says, see whatever is the first rate, take it as the lower rate, lesser rate, which is on the lesser side. So we call this as lower rate plus we see the NPV at the first value, which is a positive. NPV1 is a positive value, which means that the cash present value of cash inflows minus the cash outflows NPV1 divided by the difference between the two NPVs, NPV1 minus NPV2. So we just find out what is the difference between two NPVs into this particular fraction is multiplied into the difference between the rates. We call this as interpolation. Okay, IRR is calculated as lower rate between the two rates R1 and R2, whichever is lower. So lower rate plus there is a fraction which is taken as NPV at the lower rate divided by the difference between two NPVs, NPV1 and NPV2. Find out the difference between that. That's a delta. We just find out the difference. Multiply this fraction into the difference between rates. To find out when we substitute this, then we get what is the R value. We'll go back to the question. Now the question has certain details. It says that NPV at 10% is one NPV1. I'm writing the details here. Question number 142. NPV at 10% is equal to, we have this value as 928. Then we have NPV at, this another percentage, which is 20%, the higher percentage, it is equal to minus 628. Okay, so obviously R1, from this we can understand that R1 is 10%. And here R2 is equal to, this is 20%. UC interpolation formula, IRR is equal to, we have to have the lower interest rate first. So lower interest rate is given as R1 plus, there is a fraction which opens up. I'm putting it here, one square bracket plus bracket. In this, we have NPV1. So NPV1, the entire thing divided by, we have the difference between NPV1 minus NPV2. Okay, this is one fraction. This fraction is multiplied into the difference between R1 and R2. See, this is delta. We don't write the negative sign. Okay, the difference between the R1 and R2. Okay, if we are basically talking about delta, we can as well write it as, because higher rate is R2 and R1 is lower rate. So very precisely, let's write it as R2 minus R1. Shall we substitute the values? Here we will have, sorry, here I wrote it as, this should be plus. What is R1? R1 is 10% plus we have NPV1 as 928, then minus NPV2. NPV2 is 628. NPV2 is 628. Close the bracket. Fraction into we have just 20% minus 10%. I hope things will be fine and then the calculation works out. Otherwise, I'll just make a change and then I hope you are able to see this part of it. This is 15.964. Just click on
Yes,
the
ma'am.
percentage.
Yeah.
We get check the calculation in the formula bar. First, we wrote 10%. That is rate 1 plus we have the NPV at rate 1 divided by the difference between two NPVs, NPV1 and NPV2. So first NPV is 928, second NPV is minus 628. Close that. This is the entire fraction. Close the fraction into the difference in the rate. So entire calculation when we take it up, it comes out to be as 15.96%. Okay, so we can write it as 15.96%. One 43 says how much would FGH need to invest now at 5% to yield an annual income of 8,000 in perpetuity, starting in 1 year's time. See, perpetuity is forever it will be received. The equation is when we are trying to find out the present value will be the cash flow divided by 1 plus r whole to the power of n. That's how we find out the present value, the discounted value of cash flow. So the present value of cash flow. So now the present value of cash flow for a cash flow which would be received perpetually. So what is the present value as of today? N seems to, if it is in perpetuity or perpetual, N seems to be infinity. So in such case, we cannot calculate what is infinity. So we simply take in perpetuity, we simply take the value to be as, for this one, it would become cash flow divided by R percentage. That's it, as simple as that. Cash flow divided by, we have it as R percentage. Okay. So in that case, $143 present value of cash flow in perpetuity is equal to, take the cash flow divided by R percentage, as simple as that. So here also we just have to do the calculation in that particular fashion. So here it is equal to 8,000 divided by 5%. So 160,000. Option C is the answer. Next we have it as how much would need to be invested today at 6% per annum to provide an annuity of 5,000 per annum for 10 years commencing in 5 years time. Here we see that how much would need to be invested today. So if today there is some X amount of investment made. From this investment, the interest would be received at the rate of 6% per annum to provide an annuity of 5,000 per annum for 10 years, commencing in 5 years time. So there would be no amount which would be $144. Investment today is P. Then R is equal to after that we want the cash flow from 5 to 10 years. Cash flow from the 5th year till the 10th year is what is given to us. We have to find out what's the present value of those cash flows. Okay, there is no cash flow starting from first year till the 5th year. It is starting only from the 5th year. We can do it this way because we are just dragging it. Year starts from 0, 1, so on till 10th year. Then cash flows in the 0 year, it is we do not know what but the cash flows are expected to be earned from 5th year, which is 5,000. This will go on till the 10th year. Okay. The rate is 6%, so PV factor at 6%. First year it is always 1, then we see the next year it will be, we can only take from the 5th year because we are doing it in Excel. That's the advantage of it, is equal to 1 by 1 plus 6%, the whole thing to the power of the year. Drag it, multiply that. Present value of cash flows.